Most traders do not lose money because their strategy is bad. They lose because they used a good strategy in a market that was never going to reward it. The same breakout entry that worked perfectly last week fails today. Same rules, same pair, same trader. What changed was the condition. The market only ever does four things. It trends up, it trends down, it ranges sideways, or it chops with no direction at all. Each state pays for one kind of behavior and punishes the rest. So in this lesson, you will learn to read which of the four you are in using price action and market structure. Then we go through 7 setups, numbered 1 to 7, and where each belongs, plus the 3 traps that make a reversal look real when it is not. By the end, you will stop asking which strategy is best and start asking a better question. What is this market allowing me to do right now? So, if this kind of content helps you, take a second to like the video, subscribe, and turn on notifications so the next lessons reach you the moment they go live. And feel free to share in the comments which topics you would like us to explore in future videos. And if you want to support the channel on a deeper level, consider becoming a member to unlock exclusive content and help keep these lessons coming. You'll also find links to our trusted partners in the description below. Using them costs you nothing, and it directly helps the channel keep producing free educational content like this. Before any setup, before any entry, you owe yourself one sentence. Name the condition. Ask whether price is making progress or simply moving, because those are not the same thing. If it is making progress, you are in a trend. An uptrend prints higher highs and higher lows. A downtrend prints lower lows and lower highs. If it is moving but not progressing, you are in a range. The highs stop extending, the lows stop extending, and price turns at the same 2 edges more than once. And if you cannot draw those edges at all, you are in a choppy market. So name the condition first, and only then open your list of setups. If naming it takes more than one sentence, the correct setup is no setup at all. Condition 1 is the trending market, the only one of the 4 that pays you for holding a direction. A trending market is defined by price consistently moving in one direction over time. In an uptrend, the market creates higher highs and higher lows while respecting previous swing lows. Respecting a previous swing low means that price continues pushing upward without breaking below that level. After each breakout, the lowest point of the pullback becomes the new reference swing low, reinforcing structure. That structure is what gives you permission. Our directional bias becomes bullish, and we focus only on buying opportunities as long as price remains above this key level. But what happens if price breaks and closes below the swing low? This indicates that buyers are starting to lose control, and the market may no longer be in a valid uptrend. In contrast, a downtrend works in the opposite way, with price forming lower lows and lower highs while respecting swing highs. In this case, we define the environment as bearish and look for selling opportunities as long as price stays below the previous swing high. When price breaks above a previous high in an uptrend with a strong close, we mark it as a break of structure, also known as BOS. This signals continuation and confirms that buyers are still in control of the market. Because of that, we continue looking for buying opportunities. We then mark the beginning of that breakout move as the new swing low and define our trading range. From there, we expect price to retrace, find rejection within that range, and continue higher, ideally reaching or exceeding the previous high. But if price fails to continue higher and instead closes below the swing low, the context changes. At this point, we identify a change of character. It signals a potential reversal and suggests buyers are losing control. After this shift, we anticipate a change in direction and look for selling opportunities with more caution and confirmation. Notice what happened there. Nothing about your strategy became wrong. The condition it was built for stopped existing, and the trader who misses that keeps buying a market that has already changed its mind. Another key signal of reversal is a shift in momentum. In this example, we initially see a strong bullish breakout with large candles, indicating strong buying pressure. However, if price suddenly reverses and forms large bearish candles, it signals that sellers are stepping in aggressively and momentum is shifting in the opposite direction. That shift shows buyers losing control, while sellers gain strength, which can lead to a reversal in market direction. A trending market is often the cleanest and most profitable environment to trade, but not all trends behave the same way, and the difference between ideal and imperfect trends matters. An ideal trend is smooth, clean, and clearly respects structure. Pullbacks are controlled, and price reacts precisely at key levels, making execution more predictable. An imperfect trend is irregular, with deeper pullbacks, false signals, and choppy structure that easily creates confusion. To avoid being trapped in imperfect trends, it is crucial to recognize common market traps, especially invalid changes of character. The first one is failure to continue. If price breaks below a swing low but fails to move lower and quickly reverses upward, that change of character becomes weak or invalid, particularly if price then breaks above the previous high again. This behavior confirms that the market remains bullish despite the temporary breakdown. The second trap is a liquidity hunt. If the swing low sits in a liquidity zone, price may briefly break below it to trigger stop losses and then reverse. This move is not a true reversal, but rather a liquidity grab, making the change of character invalid. The third trap is fair value gap mitigation. If a fair value gap exists below the swing low, price may drop to fill that imbalance before continuing higher. The move is only a reaction, not a structural shift, which again invalidates the change of character. All three do the same thing. They convince you the condition has changed when it has not, so you flip your bias at the worst price. Avoiding them means refusing to rename the market on a single candle. Now that the foundation is clear, we move into the setups, numbered 1 to 7. In a trending market, they divide into continuation and reversal. Setup number 1 is buying the pullback after a break of structure. Instead of chasing price, we wait patiently for a pullback to enter at a more favorable level. We define our range from the swing low to the new high and wait for price to retrace into that zone. The ideal scenario is to see rejection around the 0.618 Fibonacci level, or within a fair value gap, before entering the trade and targeting at least the previous high. It is one of the safest ways to trade within a trend because you enter with confirmation instead of chasing. Setup number 2 is the break and retest. In a bullish trend, we wait for price to form a double top rejection pattern. Once price breaks above that key level, we wait for it to return and retest the same area. If the level holds and price shows rejection, such as a long wick candlestick, we enter the trade and place the stop loss below the zone. In a bearish trend, the logic is mirrored. We wait for a double bottom rejection pattern, and if price breaks below that level, we wait for a retest. If the level holds and price shows rejection, such as an engulfing candlestick, we enter the trade and place the stop loss above the zone, maintaining proper risk control and structure. Both of those assume the condition continues. The next two assume it is ending, which is why they demand more evidence. Setup number 3 is the change of character entry. After a long-term bullish trend, we wait for price to form a clear change of character. To confirm a valid reversal, we need at least 1 or 2 strong bearish moves that break below the previous swing low. After that, we look for fair value gaps that form following the CHOCH and set a sell limit at the beginning of that gap, aligning with the new bearish context. Next, we place the stop loss above the setup and target the next significant level below the current price. Setup number 4 is the inversion fair value gap with liquidity. A high probability setup appears when price sweeps liquidity above previous highs and then forms an inversion fair value gap. This clearly indicates a shift in momentum after an extended uptrend, where the market takes buy-side liquidity and begins moving towards sell-side liquidity. When we combine a liquidity grab with an inversion fair value gap, the setup becomes even more powerful. Now let us change condition. Trending markets are often preferred, but the reality is that markets spend more time moving sideways. If trends are the only thing you trade, you will spend most of the year forcing trend logic onto a market that is not offering it. A sideways or ranging market occurs when price stops forming higher highs and higher lows, or lower highs and lower lows. Instead, price moves between a clearly defined high and low, creating a horizontal structure. In this environment, the market is no longer trending and is moving between support and resistance levels, which requires a different trading approach. Before trading a range, we need to identify it correctly. Look for at least 2 rejections from the bottom and 2 from the top, showing that price respects both support and resistance. Once those levels are established, the market can be considered ranging, remembering that more touches strengthen a level but do not guarantee it will hold. And the cleaner the levels, the better the setup. When support and resistance are easy to identify and price reacts clearly at those zones, the range becomes more reliable to trade. Setup number 5 is the third touch. The third touch of a level is often the most significant because it signals a higher probability reaction. When price approaches a level for the third time, we look for confirmation that the level will hold. If price is at support, we look for rejection to the upside, but we do not enter immediately. Instead, we wait for confirmation, such as a rejection wick or a strong move away from the level. Once that reaction is visible, we can enter the trade with more confidence. It is also possible to trade later touches of the level, but ideally with reduced risk to account for weakening structure. Setup number 6 is the break and retest within a range. When price breaks above resistance, that level can turn into support. We then wait for price to return and retest the level, and if it holds with clear rejection, we look for buying opportunities. On the bearish side, when price breaks below support, that level becomes resistance. We wait for a retest, and if the level holds with rejection, we look for selling opportunities, maintaining a structured approach in both directions. Sometimes, price breaks above resistance but fails to continue higher. This is known as a failed breakout. Instead of holding above the level, price quickly drops back into the range, showing that the breakout lacked strength and buyers could not maintain control. This is the range-punishing trend behavior. The trader who bought that break was not using a bad setup. He was using a trend setup in a market that had not become a trend yet. To handle this, we introduce setup number 7, the inside bar. The inside bar is a candlestick pattern where one candle forms completely within the range of the previous candle, known as the mother candle, indicating consolidation and indecision. In an uptrend, it suggests buyers are pausing and not pushing price higher. In a downtrend, it shows sellers losing momentum and the market slowing down. This pause typically comes before the next significant move. We trade inside bars as continuation setups. First, we identify a strong trend, then wait for the inside bar to form. After the pattern is confirmed, we enter on the breakout of the inside bar, aligning with the direction of the trend. In an uptrend, we look for a buy after a breakout to the upside. In a downtrend, we look for a sell after a breakout to the downside, with the target set at the next key level in the market. The best inside bar setups often occur within a ranging environment. To reduce the risk of false breakouts, we wait for price to first break above resistance, indicating a possible continuation. Then we wait for an inside bar to form, confirming a pause before the next move. Once price breaks above the inside bar, we enter a buy position, as this signals that buyers are stepping in again after the pause. Our stop loss is placed below the mother candle, and the target is the next key level, allowing for a structured and controlled trade. This approach helps us avoid false breakouts and only participate when the market confirms direction. That leaves the fourth condition, and it is the one that quietly decides most trading accounts. A choppy market is messy and unpredictable price movement, where price moves up and down without a clear trend or structure. You recognize it by what it refuses to give you. Levels break and immediately fail, candles overlap with long wicks on both sides, and there is no swing high you would trust. In these conditions, the market generates many false signals, making it difficult to trade effectively. The best approach is patience, waiting for the market to transition into a clearer trend or a well-defined range. And the real damage is not the small losses, it is the state they leave you in. You arrive at the next clean trend already frustrated, already trading smaller, already doubting rules that were never the problem. So recognize this environment early and protect your capital by staying out. Standing aside is not a missed trade. In a choppy market, it is the correct application of the strategy. Finally, it is important to understand that waiting for high-quality setups and filtering out low-quality ones is a skill that must be developed over time. Here is the thread running through all 7 setups. They are not 7 opinions competing for your trust. Each one answers a specific question the market is asking, and the only way to answer well is to know which question is on your screen. Read the condition correctly, and an ordinary strategy becomes consistent. Read it wrong, and no strategy will save you. So, trader, if this video brought you more clarity, like it, Subscribe and turn on notifications so the next lessons reach you. And tell me in the comments what you want me to cover next. And if you want to go deeper, you can become a member of the Com Lucro Trader community right here on YouTube. It unlocks exclusive content, early access, and extra tools for your development, while directly supporting the channel. You'll also find our trusted partners linked in the description. Using those links costs you nothing and helps us keep producing this kind of educational content. And remember, the mission of the Com Lucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you'll find complete courses built as a true trading masterclass. Liquidity, market structure, higher time frame analysis, and supply and demand. Always focused on reading price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency. Because trading isn't just about charts, it's about mindset, discipline, and execution over time. Our main courses include smart money concepts, ICT, technical analysis, trading psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you understand how markets really behave. Thanks for watching, and I'll see you in the next video.